Have you maxed out your pre-tax retirement plan contributions for the year? Would like to put additional money into Roth accounts but can't because your income is too high? In today's video, we'll discuss a financial planning strategy which might allow you to do both. With a Mega Backdoor Roth contribution, you might be able to sock away much more money into Roth retirement accounts than you thought possible, further strengthening your finances to achieve all the things that are important to you. Welcome to Wealth Matters for Physicians, the channel brought to you by Altfest Personal Wealth Management that provides physicians with key investing and personal financial planning strategies. For 40 years, physicians have relied on Altfest to help them achieve their financial independence and the future that they deserve. We can do the same for you. Today we're talking about a great strategy to build wealth that many physicians are not even fully aware of. That's the Mega Backdoor Roth contribution. Steve, can you just start out by explaining what exactly is a Mega Backdoor Roth contribution?
Sure. Let's actually start by just talking about a typical 401k plan. We're going to work our way through it and show you what the advantage of this is and how it works. On an individual in 2023, if you're under 50 years old, you can contribute $22,500. If you are 50, the limit is $30,000. In 2025, those numbers will change because there's also an additional contribution for people in their early 60s, but that's still to come in a couple of years. Typically on top of that, if you work for a company, they do a contribution for some percentage of your income. Let's just call that number $10,000 for simplicity's sake. So if you're under 50, you now have $32,500, and if you're over 50, you now have $40,000 in your retirement plan for the year. But that's not the limit that you can contribute each year. In 2023, the limit for an individual who's under 50 is $66,000, and for someone who is 50 and over is $73,500. So we now, with what we just talked about, we have a gap of, I just said $40,000 for the person over 50, so there's an additional $33,500, and I think the amount that we just said is the same for the person under 50. So the Mega Backdoor Roth, if your company allows it, or if you are self-employed and you choose this option to have in the plan, allows you to put money into a post-tax account. So you are taking cash from your taxable accounts, putting it into a 401k contribution, not into a Roth, into traditional, as a post-tax contribution. So you get no benefit in tax savings for doing that. And what you do is you instantly roll that over into a Roth, hopefully within the plan itself, potentially into a Roth IRA. But that all of a sudden now allows you to put in $33,000 more that from that point is tax-free. It will grow and come out of that account tax-free. So if you're young enough, that will grow for 20, 30, 40 years. Typically, the last money we take out of a 401k plan for retirement usually would be the Roth money. It's great assets to grow and also to give to the next generation. So if we're talking about wealth management for and estate planning, it's a good asset to have.
Great. So just kind of highlighting some of the great things you said is that, right, many people think that they're capped out at contributing either $22,500 for people under 50 or $30,000 for people under 50 and older, but you have this total amount that can go into a 401k or a 403b of either $66,000 under 50 or $73,500 over 50, and so you take what you can contribute, then the employer match, and that difference is after-tax money. And then, like Steve said, it can you want to make sure that it can go into either the Roth 401k or 403b section of your workplace retirement plan, or directly out into a Roth IRA that you have. Right. It sounds very intriguing, contributing much more into a Roth, and especially some of our physicians are very high income earners, and they're not able to contribute directly to a Roth IRA.
Correct. But this is something that you do want to check with your HR to make sure your plans have it included. And as I said, if you're self-employed, this could be something that you can add to your plan. It's a limited cost, about $1,000 to set up and a few $100s additional each year for the overall plan. but that's really minor when you think about how much money you can actually be putting away into this.
Right. I mean, if you work for yourself or you're one of the leaders of your practice, you can definitely make the change.
Yes.
If you are a physician who's a hospitalist and working for a big institution, you can check to see if you are, one, able to make those post-tax contributions, and if they're able to immediately transfer to the Roth 401k or 403b or to your Roth IRA. If they're not, you can definitely advocate to see if that can be adopted in the next plan year, because it can really help you. And like you said, having all that money in Roth, you've already paid the taxes up front, but now you're getting that tax-free compounding growth over potentially decades, making a huge pool of tax money where you never need to take a distribution and your spouse would never need to take a distribution. And if it went to your heirs, then they would very likely have to take the distribution, but it's tax-free, but over 10 years. So a really powerful opportunity.
Absolutely.
Anything else that we need to be aware of? Just highlights for our people to start tracking it down if they're interested?
Oh, as I said, the biggest thing to track it down is really to find out what your plan that you're being covered by is entitled to, what you have the ability to. If it's not there, ask for it. It's not a high cost event. It really doesn't cost it's ongoing maintenance. It's a minor cost from the third-party administrator standpoint, but it's really your own assets that you're putting into this. So the company is not paying to put money into these retirement plans for you.
Great. And the last thing I'll say on this too is that you want to make sure, if you're going to contribute a lot in post-tax dollars, you want to, of course, make sure that you don't use up all your post-tax dollars. You want to make sure you've got your emergency fund. You want to make sure you have enough living expense money for day-to-day cash management. But if you've got that cash available, it's a great opportunity. Well, thank you very much, Steve, for talking to us about this. I think this is a lot of people are going to go to their HR or to their partnership meeting and bring it up.
Thank you very much.
If you'd like to discuss the information explained in today's video, receive a complimentary review of your investment portfolio, or a retirement readiness analysis, or discuss any other personal financial planning area with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732, or by emailing Jesse at his email address, which is also in the description of today's video. If you liked today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them strengthen their finances. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd really love to hear from you. So please give us your comments in the comments section below. Well, that's all for today, physicians. Thank you very much for attending today's video, and I look forward to being with you in our next one. Until then, please remember to keep strengthening your finances, or let us help you if you'd like.